Everyone to the New York Alternative Investment Roundtable. This is November's event, Investing for a Healthy Recovery, Current Opportunities in Healthcare Equities. I'm Ali Toko, President of the Roundtable, and we're glad you're able to join us this afternoon. First off, I'd like to take a moment to thank the Roundtable sponsors. We're glad to have such a wonderful group of sponsors who are so actively involved in the industry. You should see the screen with their names up there shortly. I'd also like to highlight that we'll be using the chat function this afternoon. We encourage you to use this feature and ask questions directly to our speakers, and Leslie will be able to view them and ask them and interject them into the conversation. And with that, let's launch. So today's speaker is Larry Robbins, the founder, portfolio manager, and CEO of Glenview Capital Management, and chairman of Longview Acquisition Corp. Prior to founding Glenview, Larry was an analyst and partner at Omega Advisors on that firm's U.S. long-short equity team. And before that, he was an M&A with M&A firm Gleacher and Company. Through the Robbins Family Foundation, he and his wife are active supporters of education reform, both in New York City and on the national level. He serves as a chairman of the board for KIPP New York and as a member of the board of the Robin Hood Foundation, Relay Graduate School of Education, and ZERN. And he is a senior chair of the Wall Street division of the UJA Federation. Today's discussion will be facilitated by Leslie Lake, a managing director and co-founder of Invest Financial Advisors, a boutique investment firm specializing in hedge fund and private equity investments. Prior to Invest Financial, she was a managing director of Invest Group, and before that, she was an executive vice president and managing director with the Family Advisor Group. She is, excuse me for the dog, she is a trustee of Simmons College, her alma mater, and importantly is the chair of the National Blood Clot Alliance. And now I'd like to turn things over to Leslie, and I'll click back after Q&A. Thank you.
Thank you. So I noticed that the dogs barked when they heard my name, but not Larry's name. So I don't know if I should take that personally or not. We did have a little bit of technical difficulty. Larry, can you hear us okay?
I'm fine. Can you hear me perfectly clearly?
I can hear you perfectly clearly, but I'm pretty sure your name is not Elizabeth Perkins. So I just want to make the distinction that that's what's coming up on your screen. And I will conclude my jokes now, I think, for the duration. So thank you, Ali, very much for hosting us for today's event. And Larry, thank you very much for participating. And also happy anniversary. This is Glenview's 20th year of operation. I've been a long-term investor with you, thrilled to have been along for the ride. Sorry that your anniversary is happening during COVID, but thrilled that you're having a 20th anniversary regardless. So happy anniversary.
Appreciate that.
Okay. All right, so today's topic is investing for a healthy recovery, current opportunity in healthcare equities. And Larry, you've been investing in the space long before anybody ever heard of COVID. So let's start with why you actually view healthcare as a long-term opportunity set, regardless of who is in the White House. And then let's move into the opportunity set now and into 2021 and potentially beyond that. And then we have already a few questions that have come through. I'll pose one of them to you. If you forget, then I will repeat if you ask. But what is the impact on healthcare equity due to the recent US election? And healthcare policy under a split or potentially all Democratic government, now that people are focusing their attention on Georgia, should we all flip blue? What would that mean for your space? So let's start there.
Sure. So first of all, thank you very much, not only for your long-term partnership, but for inviting me here today to speak to the group. I think we all need to acknowledge that we're going to talk about investment opportunities that are both a result of the election, the markets, and the pandemic. But you can't talk about healthcare without acknowledging the year-long battle that healthcare workers have had. It's probably been the greatest display of why healthcare workers are heroes, and so. I just want to acknowledge that before we start, because the companies we invest in and with, their people have been through quite a battle and unfortunately have quite a battle lying ahead of them in the months ahead. So we certainly want to make sure that we acknowledge that. You're also right in that we believe healthcare has been our largest sector allocation really since 2004, so over a decade and a half. And the reason is simple. We believe that there is uninterrupted demographically driven growth in the industry. And it's for whatever reason, always been misunderstood. There's been a regulatory cloud. There's been other questions about the durability of those earning streams. And we found tremendous value, not for value's sake, but we found tremendous value because there are some incredible growth companies and growth franchises that are trading at such a material discount that one gets wonderful returns, whether you buy the entire company or, in the case of us public market investors, just buy a portion of it. Those opportunities are driven by demographics with the aging of America. We know that for the next decade, while population growth is getting down to the 0.5% or less right now, because of the fact that we're going to see a decline in birth rate economically and because of the pandemic. We do know that 65-year-olds are growing at 3% per annum, and 85-year-olds will grow at 3% per annum through 2050. And unfortunately, as we get older, our bodies break down like old cars. We need more service, we need more appointments, we need more connectivity with the healthcare community. Secondly, regardless of whether there are Republicans or Democrats in the White House or in Congress, there's a growing reality in the country that healthcare should be a universal right to have universal access. And that's what the Affordable Care Act was all about. Mm-hmm. We should all remember that these things happen glacially. Medicare Part D, we used to give our seniors healthcare coverage so that if you're over 65, you could go to the doctor, you could get diagnosed, they would write you a prescription. But until 2006, we did not offer our seniors any money to actually pay for those life-saving drugs or those life-enhancing drugs. And that happened under the Bush administration. Under the Obama administration, of course, the Affordable Care Act was passed, and that reduced the number of uninsureds in the US by about a third, from about 45 or 47 million down to just under 30 million today, where we've been really hovering since 2015. And so over the last 20 years since we've been around, we've seen a whopping two large legislative bills that have both happened when one party has universal control over the House, the Senate, and the White House. And in doing such, both things expanded coverage to insurance, one for pharmaceuticals and then one for overall insurance. I do think that you see both parties going to the middle. The Republicans are now talking, and really have been talking for some time, about recognizing pre-existing medical conditions and not denying access to health care, right? Democrats have had an internal squabble as to whether universal access to health care means mandatory government health care under Medicare for all, or whether it means that everybody should have the right to access health care through affordable insurance. And the elections, everybody said they were a coin flip going into the elections, and the coin landed nearly on its side. So I think the audience is aware that while the White House appears clear that Vice President Biden will become our president-elect, while it does appear clear that the House will be about a 10-seat majority for the Democratic Party, the Senate's either going to be 50-50, 51-49, or 52-48, depending on the two runoffs on January 5th in Georgia. The result is, if you just take a step back from the elections, what you see is that moderates won throughout the election. In other words, there's been a far left and a far right. And if you actually look at the types of candidates that were highly successful, it does look like the country wanted Congress to move more towards center. And that's going to be emblematic of whether we get a 50-50 or a 52-48 split. On a 50-50 split, the Democratic Party is, of course, still significantly divided as to whether we should have Medicare for all or whether we should have enhanced Affordable Care Act. But that's going to be importantly influenced by President Biden, who has very clearly stated that he wants to build upon the Affordable Care Act as his health care of choice. So when you whittle it all down and we start with these kind of extreme views, and when we get closer and closer and closer, it was our feeling heading into the election that the goalposts were actually somewhat narrow from a regulatory perspective, and they got even narrower. In other words, you're not going to be able to have a revolutionary bill that fundamentally changes the way healthcare is delivered and accessed in our country, whether you're 50-50 or 52-48. What will happen is that if there is a 50-50 Senate, we do think that you will see enhancements to the Affordable Care Act that will do two things. Number one, it will guarantee that the Affordable Care Act will be severable in the event that this issue about individual mandate is decided by the Supreme Court. They can simply turn the tax back on, charge $49, never collect it, and all of a sudden it's not an issue. And the second thing is that healthcare bills will be evolutionary, not revolutionary, largely focused on the 30 million or 28 million Americans that are yet to be insured, but more the underinsured and the under-accessed, and connecting them to the population. Finally, what we would say from a thematic perspective is, and we'll talk about vaccines, I'm sure, as we move through the conversation, but there will be a large public health effort to vaccinate the entire population in the United States that doesn't already have antibodies. And in doing so, that's a wonderful first step for the healthcare community to re-engage underserved populations that we've seen the COVID pandemic highlight just how high of a prevalence of comorbidities and other health issues that those populations have. And not only by reconnecting them to the healthcare system for a simple one and done shot, but by trying to using that effort to reconnect them to regular visits, to diagnoses, to laboratory testing, and to corrective actions to truly treat those underlying conditions and hopefully get out ahead and start monitoring for them. We do believe that the conditions are set for a pretty dramatic and long-term updraft in the amount of utilization that we actually engage with in our country. So coming in to this pandemic, we had a certain baseline utilization. We've seen that utilization fall off a cliff in March and April because people were told not to go to a hospital. It's steadily built back to being anywhere between down 10 and down 5, down 20 and down 5, depending on what aspect of healthcare you're looking at. Not only will we get back to that baseline trend, and there will be in the first year a little bit of catch up, but we do believe that there's a strong pathway, red, blue, or purple in Congress, for there to be greater re-engagement of the underserved population that likely will be an additional tailwind beyond demographics as we move through the next 5 years.
Okay, let's table the utilization recovery discussion for a little bit, because we will want to circle back to that a little bit later. So basically, one of the questions we also received was the Affordable Care Act vulnerable within the Supreme Court as it works its way through? It sounds like you're saying no, that it's alive and well.
Look, we're humble enough to know that there are some technical issues and issues of law that may take precedence over what I would call common sense issues and issues of intent. So, and not that the judges aren't going to make common sense, but there's lateral precedent issues that they need to think, where they can't just think about what would have been good legislation, but they need to think about what are the lateral implications of the ruling. But as I mentioned earlier, the only reason that the Affordable Care Act is being challenged is because of this circular argument that a Republican Congress turned off the tax or penalty for the individual mandate, and then turned around and sued, saying, since there's no tax or penalty for the individual mandate is therefore illegal, therefore the whole bill is illegal, and they kind of bootstrapped themselves up to an argument. It is highly, highly likely that the Supreme Court will either rule against that argument on standing, simply that there's no standing for the people who brought the suit to bring it, right? Or on severability, that the clearly congressional intent can be met by just severing the individual mandate portion from the rest of it. Again, the individual mandate was a funding mechanism. It was designed so that healthy people would buy insurance that likely didn't get full value of it, that would subsidize the fact that insurers would have to cover the truly sick population and that they might lose money for that. So there are other ways for that to be funded. It was a funding trick, et cetera. Clearly the public rejected. If I'm 23 years old and feel healthy, why should I be forced to pay X dollars per month or X dollars per year for insurance if my liberties, my individual liberties in the US say, I just don't want to do that, right? That's the part that I think people had an objection to. But I do think that there's a broad swell of support, even from a legal perspective, that the Affordable Care Act intent was clear, that providing that exchange is going to be there. So we do not expect that to be functionally overturned, whether it be by the Supreme Court or by an act of Congress.
Okay, thank you. All right, let's talk vaccines now. There's been some pretty amazing data in the last 2 weeks out of Pfizer, Moderna, J&J. I know you've done a lot of work around this, so let's discuss the outlook, the timeline, and what is the impact of all of this on some of the names in your portfolio, and then bring this back to what this does mean for above average growth within healthcare utilization, so we can kind of put this in context.
Sure. So there's many questions about the vaccine. The first question that the market wanted to assess, both as humans as well as investors, is does it work? And we know that the precedent was for things like measles, mumps, and rubella, that you get high 90s efficacy, all the way down to the common flu shot, which is about 50% effective at preventing flu, though it's much more highly successful at dampening the severe impacts of the flu. And the results are great. The early results are that approximately 95% reduction in the transmission of the disease. So those are great. The second question that we needed to answer was the safety profile of the vaccines. And again, one can only do a short-term safety outlook because they haven't been used for the long term, but the safety and tolerability has been excellent and very, very consistent with other vaccines that people take. The principal side effect was drowsiness, and occasionally get a little bit of redness and inflammation around the injection point. That's something we all as parents have seen in our children as they get their required immunizations. So I would say that so far the results have been perfect from the perspective, or near perfect perspective, of both near-term efficacy as well as safety. We will not know the answer to, nor can we wait as a society to know the answer to how long these vaccines will last, or the long-term safety issues, simply because there's no scientific reason to have any doubt about the long-term safety issues. Even if it only lasts 6 months to a year, it would be best for our population health, also our economy, for vaccines to move through the system. There have been recent published articles that suggest that SARS immunity has lasted for 17 years. And that is highly extrapolable to what is likely the immunity that you would get from a COVID vaccine. And so there are a lot of reasons to believe that this immunity will be long lasting. Our base case is that this is likely a vaccine that will need to be boosted every couple of years. But there are lots of good arguments, and the evidence so far, it seems to be pushing on the longer side of that. That whether this is a one and done or whether this is a longer term vaccine, it does appear that there are significant data behind the fact that it is likely to be longer in length. More pressing for everybody, for my 83-year-old mother who is dying to get out of her house and go see her grandchildren, more pressing is, when will the first vaccines hit the general population? How will those be distributed? How quickly can the vaccine makers ramp up production? And we don't have a total picture of that yet, but I would say that our best estimate is as follows. Phase 1, which will include the elderly, it will also include frontline workers, including healthcare workers, who are most vulnerable to contracting the disease, given the patients they work with. Those are likely to be in phase 1, and we do believe that there will be millions of doses given in December, so next month. So we think it's upon us. We think Pfizer files tomorrow, and we think that we are in a cadence now where every week or every 2 weeks you're going to get both good news from another supplier that they've gotten good data, as well as you're going to start to get EUAs and then shipments out to the market. The U.S. government, through I think what was called Operation Warp Speed and DARPA, did fund the research of almost every major vaccine provider, and in doing so, anchored the order book. We assume that about 50% of all the production of vaccines outside of AstraZeneca, which has tremendous production capacity and some deals with India and other world leaders. We believe that about 50% of the initial volume will go to the U.S. So when we run those things through, I'm sorry?
Do you think that gives the U.S. a leg up on potential growth opportunities in 2021 and onward?
I think by a matter of months, it does. But again, I think it's only by a matter of months. I think when we look at the timeline, mobility will likely increase over the summer because it's summer, because the weather will naturally dampen the effect as well. So I don't think that that's an investable difference, but I think it will be measurable in the second and third quarters of next year. It will be a measurable difference, but not necessarily an investable difference. We should note, by the way, that U.S. is coming, of course, from a deeper hole, given the disease prevalence here versus, for example, in Australia or other places, in Asia, they've done a phenomenal job of controlling the disease. So because we've had a deeper disease incidence, we're likely to have a greater uplift from a mobility perspective. So I do think that phase 2, which is the question on all of our minds, which is if we're not in one of those phase 1 categories, when can we get that? I think the inside date is March. I think the expected date is April. I'm hopeful that you can see some of that in March. Keep in mind that you're going to need one injection. For most of them, you're going to need one injection, wait 21 days, get a second injection, wait another probably 14 days. And whether they require a confirmatory test, I certainly would recommend that people get a confirmatory antibody test to confirm after those, 35 days that in fact that the vaccine has transferred the antibodies in a measurable way, so that you can then feel comfortable demasking and getting greater mobility. So if we play that timeline out, it's going to be tough to get a seat at a blackjack table in June in Las Vegas. And I do think that for the first time in this battle, in the last several weeks, there's been real light at the end of the tunnel with this confirmatory vaccine data that I think allows investors to potentially shift legs. We've seen that aggressively earlier this month, but we think that that has much further to go.
Okay. And specifically within the portfolio, the vaccines influence what names?
Sure. So what we've seen in the economy is, people want to know whether it was me a U, a V, a W, an L, or whatever. And the best letter that people thought of was that this is the K economy, that half of the businesses in this economy kind of went straight up as a result of this, the so-called stay-at-home businesses. And then half of them went straight down, which are the ones that are design and mobility. The easiest to, of course, understand is the travel-related names. We are not long nor not recommending that people buy capital consumers like airlines or like cruise ships, because yes, while their businesses will turn back on, the amount of cash losses that they are racking up every day as this pandemic rages on are material, and that's debt that they will eventually have to pay back. So unless you have a business who could be just simply slower cash flow positive or cash flow neutral, then in fact, many enterprises have gone backwards. So I think that's why you've seen, good news rallies and those types of names be extremely short-lived, because the most careful analysts understand that American Airlines total enterprise value is actually higher today, even though the stock is lower, because of all the debt that they've had to take on in order to fund the cash losses of their operation. The aspects of the bottom leg of the K that we are really interested in are the things that are not only deferred by behavior, but that there needs to be a catch-up, and that these are mandatory businesses. And so within healthcare, we talked about healthcare utilization. Just to throw you, some statistics. In April, hospital admissions were down by 1/3, right? And surgery cases in surgical centers were down by 80%. And I think it was actually a massive policy mistake for us to nationally close and discourage any hospital visits and any surgical center visits for what they called discretionary procedures defined as anything that you actually make an appointment for. And there's not a Johns Hopkins counter that counts up the number of lives lost or health affected by that. But we know that people who needed a organ transplant, while that was considered life-saving for them and therefore a mandatory procedure, their relative who was donating the organ could not do it because that was considered a schedule and deferrable surgery. We know that cancer surgeries and cancer screenings, we know that women's health screenings, we know that heart screenings all got deferred, right? And people didn't stop having cardiac deterioration. We just turned our backs on those patients and told them not to come. We told them not to come to save ventilators that ultimately were completely useless. The Northwell study showed that only 3% survival rate of seniors on a ventilator. And so again, the intents were good, and in the fog of war, people do things that are quick. But I think the medical community has come to understand things that a lot of people were shouting at the time, which is that the medical community needs to treat whole health, not just COVID health. And which is why in this big wave that we're seeing, I believe that there's a much more balanced and reasonable and appropriate policy response, which is to not only make sure that we have enough capacity to treat COVID, but enough capacity to treat all of the health issues that we engage with the community of providers for. And so for those reasons, even though we know that there's been an uptick in October, hospital admissions are now only down 10%, not 33%, and surgical cases are down 5 to 10%, not 80%. And so there has been a resumption. We're still well below trend, but there's been a resumption, and we know we're going to get an uptick, and we may get a series of rolling blackouts, and we may see some, unfortunately, horrific situations. El Paso, which is a very porous border near Juarez, there's an outbreak of cases, and the hospitals are overrun there, and it's very, very sad on a human level. Those are going to likely be the exceptions. In general, the provider system is well able to handle the caseload and remain open for business for all the other health issues that we all are dealing with. What does that mean from an investment perspective? It means that hospital stocks, which are down material on the year, such as our largest holding, Tenet Healthcare, are not only likely to see their trends normalize as a result of a vaccination and people feeling safe to re-engage the hospital, but in fact, there's likely to be catch-up because all those deferred procedures for things like hip and knee replacement or cataract surgery or other truly deferrable surgeries, those are eventually going to happen. And that will happen in the backlog, particularly if our seniors get vaccinated and then feel more safe re-engaging with the health system. We own Laboratory Corporation of America, or LabCorp, which has been, along with Quest, one of the two kind of unsung heroes in this pandemic. People talked about the dramatic inadequacy of testing early, and it was grotesque. And it cost us a lot as a country. Once the government engaged the private testing industry, with companies like Thermo Fisher Scientific and Hologics providing the equipment and the solutions, but LabCorp and Quest actually ramping up commercially their ability to do the tests. We've gone from having no testing to 100,000 a day. Now we're up to 1.7 million tests a day. And the gating agent is not the test availability, it's people's willingness to go actually get tested. We are no longer capacity constrained, and turnaround times in general are down to a day and a half. Except to some hot spots of the country. So, so while LabCorp's business in COVID testing is certainly elevated, right? People generally look at that as one-time earnings, and they're kind of looking through that. What has been heard is the normal testing, right? If you don't go to your doctor, you don't get a lab test, you don't consume a Boston Scientific a piece of medical equipment, you don't go to a Tenet or an HCA hospital, you don't participate in an IQVIA-run contract research organization, an IQVIA-run drug trial. All those businesses across the portfolio and across the specialties have been depressed, and it's had a negative effect on the near-term fundamentals. In most businesses, we would expect investors to look through a unique event. If a retailer has a hurricane and their store gets blown down or closed for a week, most people don't really care about the fact that they lost money. There was a catastrophic storm in the hospital industry. The federal government, through the CARES Act, basically ensured that. And for whatever reason, people are still terrified that the provider industry is going to be perpetually impacted by this COVID environment. I do think they're going to be perpetually impacted. I just think the perpetual impact is constructive rather than destructive, which bodes quite well for our portfolio. There's a bunch of things that are more subtle but have impact. So for example, Bausch & Lomb, a company we could talk about later in more detail. Bausch Health Companies is a medical conglomerate, but they've seen their EBITDA go down by about 10% in what I would call death by 1,000 cuts. They make contact lens solution. If we don't leave our homes, we wear glasses, we don't put on our contacts, and we need less solution. Their largest drug is Xifaxan for IBS-D. Well, people aren't going and connecting with their GI doctors right now because that's a doctor's appointment that many of us always want to put off and never deal with, and now we have a good excuse to put it off and never deal with. But it doesn't mean that IBS-D cases have diminished. It just means that they've been deferred. And so when you look under the portfolio of some of these companies, even though there's only been a, call it 10% headwind to EBITDA coming from a bunch of small things, it's extremely meaningful, it's very transitory, and it's coming back, and it's going to come back quickly. So all those things are, I think if one wanted to simply throw darts, I think you can own the hospital industry, the hospital supply industry. I think you own the medical device industry. I think you can own the lab industry, all of which have had some recovery off the lows, but have an enormous amount of growth and value in front of them.
One of the things that we haven't addressed is telemedicine, and whether or not this is a recipient of COVID that will stay with us post the vaccines. Is this an investable area for you? Do you kind of trailing off once the vaccines come into play? And another question for you is within the hospitals themselves, because they're really under financial pressure. And what does that mean for the space? Should we anticipate potential bankruptcies, mergers, et cetera? How healthy are they themselves?
Sure. Let's take that question first, and then I'll go into telemedicine. So the hospital profitability in the U.S. has always been questioned, and the best way for us to think about it is to look at the 5,300 individual hospitals that exist in the U.S. About 18% of them are for-profit. That's who's owned and traded in the public markets by the universal health systems and the HCAs and the tenants of the world. And in general, they have EBITDA margins of about the mid-teens. They're large-scale providers, and scale lowers cost, and lower cost equals better margins. As well, they tend to be have great specialists. They can use their financial prowess in order to hire great specialists, and those specialists tend to therefore get greater commercial demand and commercial volumes that drive commercial coverage and higher reimbursement. So that cocktail has been in place and will remain in place. Then if we look at about another 20% of institutions that are not-for-profit, they're largely in the academic not-for-profit community, and they are phenomenal institutions as well. The Mayo Clinics, the Cleveland Clinics, the NYUs, the UPMCs of the world, who are academic institutions. They also, because of their brain power, draw very sophisticated case mix. They draw a large commercial coverage. They have scale, and that also generates about 9 or 10% EBITDA margins. But therefore, more than 60% of hospitals are not only not-for-profit by charter, they're not-for-profit by income statement. Coming into the pandemic, they didn't make any money, and the pandemic significantly hurt them. We saw a very large outpouring of support, therefore, from Congress, including, for example, Mitch McConnell, who's not traditionally known as a hospital supporter, but who campaigned on the amount of money and aid that the CARES Act gave to Kentucky-based hospitals and Kentucky-based healthcare providers. There's only two ways to rationalize the profitability of the hospital industry, right? Because they can't take prices down anymore. They either need to decide it's okay to close more than 3,000 hospitals, largely community hospitals, by lowering reimbursements further and driving them out of business, in which case Tenet and HCA and UHS and others will see a significant uplift in bed utilization. They don't run 100% utilization. So like a hotel who's got 20% open rooms, they'll have 20% open beds, and guess what? They'll be filled, right? By the way, we just saw that we need excess capacity in the health system in the world. The last thing we need to do is reduce ventilators, reduce beds, reduce ICU spaces. So that's not going to happen. Or Congress needs to adequately fund, the provider community. And even in the height of the debate, the political debate, Elizabeth Warren, who was campaigning under a Medicare for All plan, she came out in early November of 2019 and said, the first thing I will do under my Medicare for All plan is I will increase the payment we pay to hospitals by 10%, because she knew if everybody got down to a Medicare rate, that their profit would disappear, and she didn't, and the not-for-profits would lose 10% margins, and therefore they'd go bankrupt. And nobody wants to see that. So this concept that Medicare for All means bankrupting the providers, you only have to look to what one of the most fervent advocates of Medicare for All said, which is we need to pay the hospitals more. And so from that perspective, we see a very, very long, strong funding base for hospitals. But again, you have to be scale, you have to be focused on quality, and then you have to be a system that's committed to bringing technology in-house. And instead of being scared by the technology migration and things like I'm going to turn to, which is telemedicine, you need to be a hospital system that embraces technology, that embraces value-based care, so you can improve patient outcomes at a lower cost to the system. And so that's where telemedicine comes in. Telemedicine is just another extension of what HCA has been doing this whole time. I mean, for the last 15 years, hospital volumes have gone down by just under 1% per year for the last 15 years. HCA stock's up more than 11-fold in 9 years. That's not a new concept, but and their volumes are up because they continue to take share. How? Well, they then got into the urgent care business. They got into the primary care business. They have a small amount of ambulatory. Tenet has a lot more ambulatory. These companies are not just standing in the walls of a traditional hospital institution. They are moving to get closer and closer to the customer and at lower and lower cost settings. Telemedicine is a good idea for limited applications. It has had explosive growth because of COVID, because people decided it wasn't safe to go see your doctor. But there is not the technology today to do a true exam through telemedicine, right? We all know that if we bring our children into the doctor, at a minimum, they're going to take a stethoscope, they're going to listen, they're going to feel around, they're going to look inside the eyes, they're going to look inside the ears. You can't do that properly in a telemedicine visit. What can you do in telemedicine? My child has the sniffles. Can you please prescribe me a Z-Pak? Love, mom. Right? Like that's the type of medicine that can be performed, but it can't be a full replacement, full stop for engagement with the medical community. And so what you've seen is a tremendous over-reliance on telemedicine. So yeah, the teledocs of the world have been great stocks, and it's been great for the people who want to play that momentum. That's a valuation we can't really relate to, but it's also a business stream that we don't think has strong growth behind it for the next several years, because they need to digest the explosive growth that they achieved through COVID. And there's no question that telemedicine is an important tool, but I think it's going to be more likely to be practiced as an extension of the services that NYU Hospital and NYU Langone provides you, rather than a business unto itself that fully stops there. One thing you didn't ask, but we saw an announcement from Amazon 2 days ago that they're getting into the pharmacy business. That's been another large overhang on healthcare. And people should have the proper amount of respect for Amazon, and a phenomenal operating company who tends to be extremely scale oriented in everything that they do. And they came out with a very interesting product yesterday, right? That does nothing new than anybody else does, but they're Amazon and they have good consumer connectivity, so they'll take some share. But it's not at all a game changer. What they had said is that if you want to give us your insurance information or your social security number, you can order medicines that you order for 30-day refills. You can order it through Amazon instead of ordering it through CVS, or instead of ordering it through Walgreens or Rite Aid, and we'll send it to you, and you can get it in 2 days and we'll ship it to you for free. Well, all those things are available, but for half the prescriptions that get filled, my doctor needs me to take that right now, or I'm in pain and I need to take that right now. So today, Amazon doesn't have that fulfillment capacity. And in fact, they can't sell class 2 narcotics. They can't sell pain medication, or they won't. And so it's a limited product set. If you want a 90-day refill, they won't give it to you. And if it's less, it's all the 30-day stuff that's chronic. So it's an interesting limited use application. But people say, oh, well, isn't that negative for the Cignas who own a PBM? Well, who do you think Amazon partnered with in order to administrate the insured pharmaceutical benefit? They partnered with Cigna, right? Isn't it not bad for Amerisource, the drug distributors, because Amazon's going to do all the distribution themselves? Who do you think they partnered with in order to distribute pharmaceuticals? Amerisource. So
we actually just had a question come through regarding Amazon, so this might be a good time to interject.
Sure.
Can you please discuss the impact of Amazon more fully entering the prescription fulfillment business? We had actually discussed this a couple of years ago with regard to some of the pharmacies, and you didn't think Amazon was such a huge threat at that point in time. It sounds like the model has changed a little bit. So answer that question for us, please, Larry.
Sure. They bought PillPack a couple of years ago to put pills in little plastic things. We thought it was a very, very niche market, but a way for Amazon to understand the market a little bit. I think Amazon will take a slight amount of share, right? 1% to 2%, maybe more in the near term, right? And it'll come out of largely the other national chains and those other programs. I do not believe that it will be material to the earnings of the drug distributors. Again, the drugs need to be distributed one way or the other, and it won't have anything to do with the fulfillment. There was also questions about the joint venture Amazon did with Warren Buffett and with Jamie Dimon at JP Morgan. And again, that's been a think tank that took some initial steps to think about making more consumer-friendly insurance options, but again, in partnership with the companies and through product design rather than to replace them. Healthcare is a scale business, and it sounds weird to say, but even Amazon doesn't today have the scale to do their own drug distribution because their scale is tiny compared to the hundreds of compared to the hundreds of millions of dollars of revenue that the drug distributors have going through their systems. So our views on Amazon haven't changed at all since the last 2 years. They're going through a slow evolution. They're going to be just like a drugstore sells some dry goods that Amazon sells. Amazon, who sells dry goods, will sell some pharmaceuticals the drugstores sell. It will not be a complete offering, but for some people, it will be a convenient offering, and that'll be a slow evolution. But it will not be material to the insurers. It will not be material to the drug distributors. We are not long Walgreens, and who it is probably material for is arbitrage businesses like a GoodRx, which traded a gazillion times earnings, and Amazon has now the exact product for free for its Prime members, and I think that will ultimately limit GoodRx's growth.
Okay, all right. Let's move on to sectors and some actual current positioning and upside.
Sure.
So we've talked about hospitals a little bit. It's your largest allocation, I believe, on the long book. Valuation wise, what you're seeing versus upside. Pharma, is that more in the special situation space, managed care, and obviously drug distribution? We've touched on Tenet a little bit. Let's walk through in more detail kind of the larger positions in the portfolio: Tenet, Bausch, Takeda, HCA, McKesson, et cetera. We've already talked about LabCorp and Meritor a little bit. So let's focus on those names, shall we?
Sure. So Tenet is 3 businesses. It's an acute hospital business with 65 acute hospitals. It's the largest ambulatory or surgical business out there under the brand USPI or US. And then they own Conifer, which is a revenue cycle management business, which helps not only Tenet but other independent hospitals collect their revenue and manage their back office. That business is being spun out to investors in 2021, likely by June. And we are positive on that business for a number of different reasons, including the fact that EBITDA has basically doubled over the last 3 years. It's been an extremely profitable business. And we also think they're very, very well positioned for ancillary business opportunities and new business opportunities. It's not going to be a top line growth business right now because of everything going on with hospitals, and they're not going to add a tremendous number of new commercial logos right now. But the bottom line has exploded, and we think that there's a pipeline of high growth opportunities. Tenet's balance sheet is viewed suspiciously because they have a high quantity of aggregate debt and they're levered at in the low fives debt to EBITDA. What people I think are missing from the equity side is that they have an ability to spin off Conifer tax-free, debt-free, right? The debt holders do not have a claim to the Conifer assets. And so we think from a valuation perspective, that's worth at least low 20s per share at a 2 times levered basis. If it was unlevered, it'd be worth the entire company right now. And you get, of course, the USPI and the acute hospitals for free. And we like getting giant businesses for free. We think the sum of the parts value of Tenet is more than double where it's trading today. We also think that there's an unbelievable management story here, which hasn't really been profiled. As you know, we are what we call suggestivists. We think and act like owners. We own a minority, but we work with our other partners so that the shareholders ultimately control the company. And there was a significant culture change and management change that happened in Tenet in 2017, where a board member named Rod Rittenmeyer first came in as the executive chairman, and then ultimately was installed as the permanent CEO. And then a physician who had been working at McKinsey named Dr. Sam Sataria came in to be president and the heir apparent to run the company. And I don't think it's quite well appreciated. Tenet's been the fastest growing profitability performer in the hospital industry. And the stock has tripled since the new management team came over. But we still think it's meaningfully undervalued, and I don't think that people are paying enough attention to the tremendous commercial acumen of those executives. We'll switch over to Bausch & Lomb, or Bausch Healthcare.
So just
Bausch
before you
is
move on from Tenet, so potential upside from here. I think the numbers you had floated before were kind of a 95% from where you are now. Is that still the case?
We mentioned the sum of the parts valuation is more than double where the stock is today, and so we are quite bullish on the financial opportunity there. Okay. As we switch places to Bausch & Lomb, again, the market's knee-jerk reaction in the beginning of the year was COVID's bad for medicine, and profitability is going to go down. Find a leveraged company and either sell it or short it. And so Tenet was a leveraged company, and then the next one I'm about to talk to you about, Bausch Healthcare Companies, has been a leveraged company for some time. This is the former Valiant, which was a highly controversial roll-up. It was a poorly thought out business strategy. It was a poorly run company. We weren't involved with Valiant on the way up. We weren't involved with Valiant on the way down. Several years after they changed management and brought in new management, we did believe that the turnaround was well underway, that the businesses were highly attractive, and the valuation was at a meaningful discount for only one reason, which is people couldn't get past the debt load. And again, not unlike Tenet, we believe that there's ways to address that through sales of subsidiaries, spin-offs of subsidiaries, and selling a stake in those subsidiaries to the public to raise equity, thereby reducing aggregate debt. And that's the exact case that we find in Bausch Health Companies. Not unlike Tenet, they've already announced the spin-off. We filed a 13D on the company in the third quarter. Shortly thereafter, they announced the spin-off of Bausch Global Eye Care, the contact lens solution business, which is a highly recurring business, highly defensive, and highly valued in the marketplace. And we believe that that spin-off will happen sometime in late 2021, and we're pushing for sooner, but there could be times for later. And we think that that business will have an equity value that it'll be spun off to shareholders that is greater than the last sale. And we believe that that company can have an investment grade balance sheet. What will remain is a diversified set of businesses in healthcare, including dermatology, including branded pharmaceuticals, including international pharmaceuticals. And some of those businesses, we think that they can also sell and monetize to reduce debt. So we look at the business and think on a sum of the parts basis, it is extremely undervalued. And the market is scared that they're going to go out and have to issue at a $7 billion market cap a bunch of equity to get down to the leverage that then they can split the businesses. But they're missing two key points. Number one is they're going to IPO or sell between 20 and 40% of Bausch Global Eye Care to raise capital. And if they spin off 60% of that business, it's still worth more than the existing market cap today. And secondly, within their RemainCo, the international businesses are high value. There's a aesthetic dermatology business called Solta, which is an extremely high value. The whole thing trades at 9 times EBITDA. Those businesses I just mentioned that I think are attractive sale candidates would trade in the mid-teens times EBITDA. And if you go from 9 times EBITDA to 11 or 11.5 times EBITDA in the pro forma portfolio, paying down debt and splitting the company, because of the leverage, you get between 2 and 3 times the current stock price in some of the parts. And that action is upon us. It's not theoretical. It's not trap value. It's going to happen. So
Okay.
it's those types of what we would call catalyst-rich situations where the market is terrified of negative momentum because of COVID. That negative momentum is going to turn to positive because of the utilization uptick we've talked about,
Yep.
as well as the fact that then we're closer to these catalytic events that will cause people to look at it with fresh eyes, and with fresh eyes will come fresh value. We do think, therefore, pardon the expression, but it's going to be a little bit of a revenge of the nerds trade for us, as only the people like us that are kind of in the weeds and paying attention to these kind of complex stories will benefit from that. But we certainly think that going from complex to simple will be highly attractive for the rest of the capital markets.
Can you give us an idea before we move on to other names, just broadly speaking, if you look at the healthcare longs in the portfolio, what kind of multiples are these companies at, and what are the growth rates like?
Sure.
And maybe compare that to S&P going forward.
Yeah. So a company like Bausch is going to grow in the mid-teens earnings per share through 2028, and it trades at 5 times earnings. So for all this discussion about the multiple of the market, et cetera, now 9 times EBITDA and 5 times earnings because of leverage. People say, oh, well, are they going to be able to refinance their debt? They were in the market yesterday refinancing their debt in the low 5s. They have no maturities now until 2024. So there aren't usually opportunities for us in this day and age to buy a great business at 5 times earnings that's going to grow perpetually, at least until they hit a patent cliff in 2028. They'll have one down year and then they'll grow perpetually after that. So in the case of Tenet Healthcare, again, when we back out the Conifer stake, we think that they're again trading at even lower single-digit multiples that I just mentioned. We love Cigna and have for some time. We've been continuous investors for more than a year. They have the lowest medical and pharmaceutical cost trend of any major insurer. They actually have pharmaceutical deflation. They've delivered their customers net savings per pill per consumer, right? Year in and year out, they've delivered the best, but last year they delivered negative. And that company is trading at 10 times forward earnings. And I think it's a widely misunderstood company. I think that people are not paying attention to the fact that technology, whether it be home health technology, telemedicine technology, other things that can improve and lower the cost of care, that is a tailwind to Cigna, not a headwind, right? And the Amazons are a partner to Cigna, not a threat to Cigna. And so we see across the board a barbelled approach where a lot of our valuation sensitive names are trading at about 10 times earnings. McKesson, the drug distributor, who will also be the national distributor to get the vaccine to everybody other than the Pfizer, which will be drop shipped directly. That company trades at approximately 10 times forward earnings. So in a market that's trading in the mid to high 20s, right, to have this kind of stability and growth with this kind of near-term tailwind, those kind of valuations, yes, I realize there's some complexity, but we've never seen a better regulatory environment than a moderate consensus, nobody really has control scenario. That's a wonderful backdrop for healthcare. We've never seen a love of the healthcare professionals like we are coming out of COVID, right? And so all the conditions are there for multiple expansion, which should fuel some pretty excess returns going forward.
Okay. Before you leave Cigna, I know you've mentioned before that you think they're going to be buying back stock in 2021, with free cash flow beginning in 2021. Is that the most accretive use of cash, do you think, for this company?
I don't think that they're going to do one size fits all. In other words, I think that they have a free cash flow yield of about 9 or 10%. And I don't think that they're going to use all of that for any one thing. I think they're probably going to give in to some investors and pay a slightly higher dividend, but a token dividend. I don't like dividends because they're tax inefficient on behalf of our investors, but we accept the fact that we're just one of many voices in that arena. There are going to be some bolt-on acquisitions that they can make that can be accretive. For example, when they bought Express Scripts several years ago, and we liked that deal, it was 17% accretive to earnings, which was more accretive than a share buyback would have been at the time. And so there will be potential additional acquisitions, probably not nearly of that scale, that add important capabilities, allowing them to grow, continue to grow and delight their clients, or perhaps add scale and are accretive. I could see them doing something in the Medicare Advantage space to bulk up their presence in MA. But if you can get a company that's growing earnings at double-digit rates, and you pay a 10% earnings yield today by buying back stock, then the day one return is 10% and the day two return grows perpetually through time. And so quite honestly, at 20 times earnings, yeah, there's plenty of other better opportunities than repurchase. At 10 times earnings, it's hard to see what financially makes more sense than to buy out the renters and let the owners own more.
Yeah, okay. All right, we only have a few more minutes and I wanna touch on two more things. So I'm going to anoint you today as the king of suggestivism.
Thank you.
And what the opportunities are there now. I mean, it sounds like healthcare broadly, and in particular the space that you're trafficking in, is just presenting some great opportunities and at some great entry points. How are you viewing the suggestivism space these days? Is it even necessary to get involved?
I do think that the tone of the suggestivism, we've never, suggestivism kind of halfway on the spectrum between hardcore activism, where people are quite rude and upfront, et cetera, and then the passive, as long as you're in the S&P 500, I don't care what you do crowd, et cetera. So we are in that engaged phase. What I would say is that engaging on things like capital structure and urgent share repurchase in the midst of a pandemic are the wrong thing to do, and we haven't been jumping up and down, even though some of our companies maybe should have been more aggressive on repurchase. But we understand the middle of the pandemic, support the public, support your employees, support warehouse capacity. Nobody knows exactly what's going on. So we understand and are appreciative of that conservatism. What I would say is that through that, the opportunity to engage companies with better ways to grow, better ways to present themselves to the public equity markets, those are still valid. And in particular, we have this massive bifurcation between equities in the fast lane presented to the ESG crowd, to the index crowd, and to the unlevered crowd in a way that people will spend literally no valuation appears to be too high versus the valuation of the complex crowd. And so all of our suggestivism is about driving complexities to simplicity to conform to the overall needs of the investors.
Okay, good enough. We have another question that came in. Please discuss the Takeda investment case and review the persistent valuation discount.
Sure. So I'll do that in 1 minute because I know we're running really short on time and I want to respect the people who are kind enough to be with us today. Takeda is a very cheap growing company. They bought Shire Pharmaceuticals, which was a large Glenview investment. They've executed on every one of the things that they said they were going to do. In fact, they increased synergies. There's a dividend yield of between 4.5% and 5%. There's double-digit earnings growth. It's very difficult for us to say, hey, look, what's concerning this company? Perhaps it is concerns about U.S. pharma regulation that we didn't really touch on in the pharma debate, in the healthcare debate. But the one thing we would say is, if there is anything that happens out of pharma regulation, it is to reduce the price that we charge in the U.S. of drugs to that which is commonly charged outside the U.S. And Takeda is the only company we can find that charges the same thing for U.S. customers as they do for outside the U.S. customers. So if they decide to collapse that umbrella, which is generally 2 to 3 times more expensive in the U.S. than the rest of the world, Takeda is insulated and immune. Now that their balance sheet is getting healthier, they'll be able to offensively deploy capital, and we certainly hope that the equity valuation will follow.
Okay, great. Allie, cognizant of time, so I'm happy to keep going with a few more questions if you want. Otherwise, you tell us.
I think we ask 1 or 2 more questions, and then the rest you didn't get to, maybe we can answer via email. So we'll put your contact details up, just as you said, to be cognizant of everybody's time. This has been really great, but let's finish up with 1 or 2, and then.
So one more regarding SPACs. So a big difference in the SPACs industry now versus kind of the 2007 frame. You're participating. Why? What are you seeing? What are you doing? I refer to this as it's not your mother's SPAC anymore. So
yes. So we took a SPAC public of $414 million. We're approaching I think tomorrow is the 6-month anniversary. I think people are aware that you get 2 years to identify a merger target and then to close that transaction. The soonest anybody does it, I think, is 6 months, and the latest anybody does it is trying to throw something together in month 24 to use it or lose it. So we certainly hope to be in the earlier side of that spectrum. The idea is that we wanted to be a value-added SPAC partner. So the reason why a company would want to do a SPAC merger is, of course, number one, to go public, number two, to access capital. But the real benefits are, can somebody not only provide you capital, but provide you intellectual capital that could be helpful to help grow the underlying asset. And so everything that we've done in suggestivism is about engaging with the companies about how to do not only lower cost capital formation to drive their company forward in better presentation, but oftentimes we come up with ideas and suggestions for the company that overall drives growth. And so we want to do one of two things. We want to buy a really good business at a discount price because that's what we're good at seeing and doing. Or we want to partner with a company and use our contacts. And we said at the time we brought it public, most likely in the healthcare field, that we could use our contacts to accelerate that growth. And if you spent 20 years developing C-level contacts across the payer community and the distributor community and the provider community, just like Leslie walked us through, I would hope that anybody that we find to partner with, that we could roll up our sleeves and not only contribute suggestions, but drive growth. And so that's the investment theory we presented in May. And of course, we're going to be hard at work and trying to bring that into fruition.
Okay, sounds great. All right, Larry, thank you as always. So interesting. I could go on and listen to you for another couple hours, but we won't. And if you want to do another call around short opportunities, we can certainly schedule that as well. But want to say thank you to the New York Alternative Investment Roundtable for hosting this event. It was great. Allie, I'll turn it over to you now.
Thanks, Leslie. And Larry, thank you for sharing your timely and really insightful thoughts on investing in healthcare. It's an area I think we've all been watching pretty closely. Our next roundtable event will take place on December 7th at noon. It is entitled Post-Election Tax Considerations 2020 and Beyond, which will feature Spark Hart, your partner at Alston Bird, amongst others, with a philanthropic bend as well. Then December 9th, we're going to host our 4th virtual cocktail event right before the craziness of the holidays. So we hope to see you then as well. Again, thank you for your time today. Stay healthy, and enjoy the rest of your week.
Thank you very much.
Thanks, everyone.
Thanks,
Bye-bye.
Larry.